Despite product shortages and store closures, Hasbro has been seeing a jump in demand in the current quarter. So what's going on? Can Hasbro bounce back? Joining us right now, Eric Handler, he's managing director at MKM Partners. Eric, good to see you. Tell us this seeming disconnect in the story that Hasbro's telling us here about the increase in demand. Where's that coming from? And then why is the stock down as much as it is today then?
Well, I think demand is coming from the fact that families are at home more and more, and children need to be entertained. And as a result of that, demand is good. We need to look at particularly board games. You want to play outside. Nerf is a good product there. Play-Doh. Those are all good shelter-at-home type products. Now, stock's down 7% today. And I don't think it's that much because 2Q results were disappointing, below expectations. I mean, that's what happened in the past. That's what happened when factories were closed for several months. I think the stock is down because even though the company said point of sale has left inventory at very low levels, the supply chain's back in working order, it's still very challenging to predict exactly how fast that recovery is going to take place.
Right. Now, Hasbro, I know a lot of its toys are based on movies and the tie-ins that they've got with the studios there. And we all know what's going on in Hollywood right now. Not much, unless it's being streamed online. What's that doing to their outlook right now?
So the licensed products is about 40% of overall business. So it's been a decreasing part of the business over the last decade, but still is very important. And they did well with Frozen 2 product, and they did well with Star Wars product. But you just didn't have the movie tie-ins that you normally see during the summer season. That got pushed out for the most part into 2021. So there's a timing issue there. But when you look at Hasbro for the big picture, what's driving a lot of the growth over the long term is its owned IP.
Eric, so it is interesting. I just want to kind of go back to the overall message here. They had strong demand for things on the gaming side. I mean, we played a lot of imitation Jenga lately, so I definitely understand that people are looking for at-home gaming. But why did the stock react quite so poorly? I mean, yeah, we don't know we don't have a lot of clarity on future demand, but didn't they do relatively well, all things considered?
They did very well from a point of sale standpoint. And point of sale, strong point of sale means inventories are at below average levels. So with the supply chain back in working order now, they can chase demand in the third quarter. That being said, Latin America is a bit of a mess right now. And the recovery that's going on in the U.S. and Europe and Asia Pacific, it's going in the right direction. But again, it's the pace of that recovery, and there's not a good visibility to how fast that recovery is occurring.
Understood, and I take your point that they need to get product out more quickly. 55% of their production is from China. Are they going to face long-term headwinds there?
Well, they're becoming less reliant on China. China right now is, like you said, 55% of production. By the end of the year, it's expected to be 50% or a little bit below. They're diversifying their manufacturing very well, not just in the U.S. and India, but also in other parts of Asia. So over time, that should decrease. But the bigger issue right now is catching up with demand.
Right. Again, usually a good problem for these companies to have, but the shares are still down today on a lot of those concerns you've outlined. Eric, thanks for joining us.